Oh man, look at Apple. It shot up 5% from the time I sold the put options yesterday at $123. Today, the Apple share price went to $134. I could have made $11 for every share of Apple. Selling option contracts sucks. What's the point of selling options contract when you can gain so much more just buying the shares? Well, let's find out, shall we? Welcome back, mindful investors. In this video, I'm going to talk about buying and shorting shares versus selling call or put options. What are the pros and cons of each? Let's talk about it. Let's find out through a couple of my recent examples. As I said in the beginning of the video, I sold some Apple contracts yesterday when the stock price dipped to around 123. So we see around the morning of yesterday, and the 21st, this is approximately where I entered at 85 cents in the morning, somewhere around here. My average price right here is 85 cents. I sold 4 contracts and right now is profitable by more than 50% because 40 cents right now to 85 is approximately maybe like 47% left. So I'm more than 50% in the money. For an unrealized profit of 180 and the potential to get the 342 for all 4 contracts if Apple stays above 110 within the next month. Okay, now we calculate what would have happened if I just bought the shares with the amount I'm risking selling the puts. To calculate how much I'm risking selling these 4 put options is 4 contracts times 100 shares per contract times the strike price I sold the put options at, which was at $110. So ultimately I was risking 44K. And then looking back on Apple, when I sold the put option, it was at 123. Today it peaked at 134. Okay, so 134 divided by 123 is the amount that the stock price went up. So this morning it was up 9%. So our 44K times 0.09, we would have made close to 4K. We could have made 4K if we bought the shares instead of selling the puts. So why do I sell puts? And why do I sell these call options? So the differential here is 4,000 compared to 400. The 400 or 342 to be exact is the maximum I can win selling those put options. But if I bought the shares, it would have been up 4K already. So why do I still sell these put options when I can make like 12 times more buying the shares? There are a few takeaways after seeing this Apple case study. Number 1 is the mindset. To me, the mentality of selling options is kind of like collecting dividends. So essentially, we're risking a lot more to collect very little. In the Apple case, I was risking 44K to win the $320. It sounds pretty ridiculous, but it really isn't. To me, this 44K isn't even at risk. Because if the Apple stock actually tanks to 110, I was more than willing to buy it at this discount of 10%, which is a win for me. And if it doesn't hit it and it flatlines above 120, I'm happy with that too, to collect the 320 premiums, free and clear. In my mind, I'm risking nothing to win the 320. But look on the other side, if I actually went in and bought the shares at 123, what if a negative piece of news came out and the stock dropped 5%? What am I gonna do? We can justify that since Apple is a great stock, then we hold it forever and hopefully it'll bounce back up across the line and we sell then. Let's say that is the scenario, that it drops 5%, it flatlines for 3 months across like 110, and then it jumps back to 120 levels 3 months away. So within this 3-month time frame, what do you gain? You may get a little bit of dividends, a 0.6% dividends, but for the stock price itself, it's just even, so you don't make anything. In the case that a crash comes and the stock tanks like 20%, what are you gonna do? The analogy is getting handcuffed because normally you wouldn't want to sell shares at a loss, so you tend to hold on to it until it surfaces back above the water, which more likely than not it will, but for how long, right? When we sell put options, we already have that 10% discount. That is a buffer. And then even if the stock drops 5%, we can move this floor down the road. We can move it further down. Maybe another month away, 2 months for another 10%. And we won't lose any money. The mentality of holding shares and selling put options is completely different. You can sell these put options every single week if you want. Okay, number 2, we will have the risk versus reward. When you're selling put options, in my mind, you're risking very little because the win rate is like 90+%. And then even if it turns south, you can always roll your options. But on the flip side, you're just getting like 1% for every one of these trades. So let's say when we're risking that 40K of margin, we're only winning the $300. So this is only about 1, but we can do it every single month. In a whole year, you can be gaining 12% out of nothing. I mean, if you want to go for the kill, the 5x, 10x, you go for the long call, long puts. As I mentioned in this video, you just go for the kill when you have conviction that the stock will go up 2 times in the next 2 years. That's how you get the 5x, 10x. When you just keep selling the put options for the next 2 years, you may get a total of maybe 20%. The bulk of your winnings will either be from your capital gains of your shares or these long call or long puts. When you sell calls and puts, you're just getting dividends. If we draw a line that says risk and reward, so if you're selling options, you're somewhere over here, where you're risking very little to win very little, because you're just gaining that 1 or 2% or 20% per year. But if you hold shares, you're somewhere in the middle, where you can hold on to the shares and the stock may double, which is 100% gain. And then if you're out here, you're buying the options, you're shooting for the 5x, 10x. All of this links up together. We're going to demonstrate this through one of my star students this year, Palantir. All of these negative positions are selling call or put options. And all of them are in the money. Some are just in it to win like $100. Some are up $2,000, $1,000, $1,000. So these are your small wins when you collect dividends off these volatile stocks. And here are the shares where you just hold on. There's no time frame to worry about. You just hold on and hope that the end price is much higher than the initial price. That's it. So these are the holdings. For me, this is more than doubled because my cost basis right here is 73K. Now is worth 181. So it went 2.5x. But these long call options are a different beast. I bought them at an average price of $3, and at its peak, this one has gone up to around $17, approximately a 5.5x. And the story doesn't end there. If the stock continues to go up to $40, $50, this position would get you the 10x. Where all of these little guys will just get you a couple hundred, $1,000 here and there. These are completely different games. And buying and holding shares is somewhere in the middle. Where there's no time limits, you buy low and sell high, that's it. If you're making all these plays on the side, selling options, you're just churning away and getting more dividends. If you're going for the long call, long puts, you're going for the home runs. So where are you in the spectrum? I'm all over the place, but that's just me. Anyways, drop a like and subscribe to the channel if you found any value in the video. Thanks again for watching, take care, and I'll see you in the next one.